Hey everyone, and welcome. Today, we're going to jump right into one of the most important and honestly most misunderstood parts of the tax code: capital gains. My promise to you, in the next 5 minutes, you'll get a super clear blueprint of how it all works. Okay, let's get into it. So, picture this. You've finally sold that piece of land or maybe some shares you've been holding on to, and you've made a really nice profit. That's fantastic. But just as you're celebrating, you get that little feeling. The tax man is coming. That profit you just made, it triggers a very specific kind of tax, and understanding it is absolutely crucial. When you boil it all down, the idea is actually pretty simple. The government is just taxing the gain, the profit that you make when you sell, or, part ways with a valuable asset. The entire system is built on just a few key ideas, and we're going to break them down one by one. Okay, our entire journey starts right here with the gatekeeper section, section 45. This is the rule that says, hey, any profit from the transfer of a capital asset gets taxed in the year that transfer happens. And here's an awesome way to remember it. Think 4-5, which sounds just like for sale. A sale kicks off the whole process. So that leaves us with two big questions, right? What exactly is a capital asset, and what counts as a transfer? So first things first, before we go any further, we have to figure out if the thing you sold even qualifies as a capital asset in the eyes of the law. This is the foundational building block. If the asset isn't a capital asset, then we stop right here. So the law basically says almost any kind of property is a capital asset. But, and this is a big but, it carves out some really important exceptions. For example, your business inventory. So if you run a sari shop, the saris you sell are not capital assets. That profit is just your regular business income. And for the most part, your personal stuff, your car, your clothes, your furniture, they're excluded too. And, there's a really smart reason for this. Why are your personal car and your jacket not taxed? Well, because these things almost always go down in value, right? They depreciate. If the government taxed them, you'd almost always have a loss, and you could use that to lower your other taxes. So they just exclude them to focus on the assets that tend to go up in value. And here is the big exam trap. This is the part you absolutely have to remember. The law specifically says that even though these items might be personal, they get pulled right back into the definition of a capital asset. Why? Well, it's pretty obvious, isn't it? Things like jewelry, paintings, and sculptures are the very things that are expected to appreciate in value. It shows you exactly what the government is interested in. They want to tax that growth. All right, so let's say you've checked the first box. You have a capital asset. Are you taxed yet? Nope. The tax doesn't kick in until you actually transfer it. So what does the law mean by transfer? You might be surprised. It's a lot more than just a simple sale. Of course, a sale is a transfer. That's the easy one. But so is an exchange, like if you barter one property for another. Also, if you just give up your rights in an asset, that's called relinquishment. Or if your rights are ended for some reason, that's extinguishment. Those count too. Even if the government forces you to sell your land for a new highway project, that's considered a transfer for tax purposes. Now for our third and final piece of the puzzle, the clock. How long you owned the asset before you got rid of it is incredibly important. It's the one thing that decides if your profit is a short-term gain or a long-term gain. And trust me, they are taxed very, very differently. The whole point of this rule is to encourage people to make stable, long-term investments, rather than just quick speculative trade. Now, this isn't a one-size-fits-all rule. The magic number actually changes depending on what you're selling. For listed shares and equity mutual funds, the key is 12 months. Hold it for a year or less, it's short-term. For property like a house or for unlisted company shares, the cutoff is 24 months. And for pretty much everything else, like gold or debt funds, it's 36 months. Let's make this real with a quick example. Say you buy some shares in January. If you turn around and sell them 11 months later, any profit you make is a short-term capital gain. But what if you just wait 2 more months? You sell after 13 months. Now that exact same profit becomes a long-term capital gain, and bam, the tax treatment completely flips. Okay, we've got our 3 key ingredients: a capital asset, a transfer, and we know the holding period. Now it's time to actually do the math and figure out the gain. The formula is actually really logical. First, you start with the full value of consideration, which is just a fancy term for the total sale price you got. Simple enough. From that, you get to subtract any expenses you had to pay to make the sale happen, like brokerage fees. Then, you subtract what you originally paid for the asset, your cost of acquisition. And finally, you can also subtract any money you spent improving it over the years. Now, here is a really cool benefit, like a superpower. but it's only for long-term assets. It's called indexation. Basically, the law gets that a rupee you spent 10 years ago was worth way more than a rupee is today because of inflation. So it lets you artificially pump up your original purchase cost to what it would be in today's money. This can seriously reduce your taxable profit. It's a huge deal. And speaking of indexation, there's one magic number you have to know: 2001. The government's inflation index starts from the financial year 2001-2002. So what does that mean for you? Well, if you have an asset that you bought before April 1st, 2001, you get a special choice. You can use its actual cost, or you can use its fair market value on that date as your starting cost, and you get to pick whichever is higher. This is a massive benefit that can save you a ton of tax. So how in the world do you remember the section number for all this math? It's section 48. And I've got a silly one for you. Think 4-8 or 4-eat. It's a good reminder that before you can eat your profits, you got to do the calculation first.
Okay, let's take a quick breath. We've covered a lot of ground really fast. We've looked at all the individual pieces, and now I want to pull it all together so you can see how they fit on one single coherent map.
So here it is, your master map. Section 45 is what kicks everything off, the charge. Section 214 tells us what an asset is. Section 247 tells us what a transfer is. Section 242A starts the clock on the holding period. And finally, Section 48 gives us the formula to do the math. These 5 pieces, together, are the complete engine of capital gains tax. So there you go, a complete overview of capital gains in just a few minutes. Look, understanding these rules isn't just about paying taxes correctly. It's about making smarter financial decisions. Knowing that the difference between holding an asset for 11 months versus 13 months can make a world of difference to your bottom line, that's powerful stuff. So the next time you think about selling a big investment, you'll have the framework to think it through like a pro.